Yeah, so I'm pretty sure this is recording. So today's topic, order blocks and fair value gaps, and how you can actually take your trades and manage your trades with these two. So before I start, just to give you a brief overview of what I would want to cover in today's topic. So in terms of order blocks, you should know how you would define an order block, how you would validate your order block, and then how you would take your trade based on the order block, and how you would manage your trade, more so specifically in terms of placing your stop loss, not your take profit. And when it comes to fair value gaps, you should be knowing more or less the definition of fair value gaps, how a fair value gap would look, what is obviously a bearish fair value gap, bullish fair value gaps, and how you would use the fair value gap in conjunction with order blocks and all the previous lectures, more so specifically the open, high, low, and close of the candles. So just to let you know before I start that, let's say I open my charts. The first two things that I always see when I open my charts, or something that my eyes are attracted to instantly, are these two things. Where are the order blocks? Where's the fair value gap? I opened the chart at a time where a higher time frame order block is being, a higher time fair value gap is being filled, or what is happening with that? And that's what I base my trades on. So let's start with what do you call it? Order blocks. So by definition, an order block by definition is a bit complicated. It's better off if I just show it to you. But essentially, if you talk about a bullish order block, so that would be that bearish candle which forms the complete low from the previous candle. All right, that is the definition of the bullish order block. So if I give you an example right here, let's take this, take the brush. So if you look at this candle right here, this black candle, it is a black candle because it's a down close candle. It has taken or pierced through this candle, all right, making the lowest of the lows and finding support somewhere. Now, what do I mean by support? I'm going to come back to that later on when I explain fair value gaps. Okay. So essentially this candle has formed the lowest of the low, has found support at a higher time frame or that time frame. All right. Now, how would you validate that this indeed, in the couple of minutes, 15 minutes, 4 hours, whichever time frame that I'm looking at it, would be a validated order block? It would be a validated order block if the next candle that is formed, right? Let me just get rid of this. The next candle that is formed pierces straight up through it, which has happened here. Now, when I see the formation of this, okay, for me, this is a valid order block, a valid bullish order block. Why did that happen? Because I have a down close candle that has pierced through previous candle, whether it's an up close or down close, does not matter where the blue line is right now. It has pierced down through it. It has found support on that time frame or at another time frame. And I'll explain that support later. It's not the classic retail support that I'm talking about. And then what happens? I have to validate my order block. How am I validating my order block? I have another candle after that candle, which is an up close candle, has pierced straight up through it. Okay, so now I have an order block. What's going to happen now once I have an order block? When an order block is formed and you have all your other confluences aligned, how will you take a trade based on that order block? And in essence, what does that order block actually tell you? What is an order block? So it is that candle where all your institutions would place your orders. If you want to go long, or rather if your institutions are going to go long, it is going to be essentially, this place over here is where your institutions will place your buy orders. And naturally, look at what happens. Price goes up, comes down once more time, as I told you. What is happening? As I told you in the previous lecture, before going up, comes back down, dips into what? Your order block right here. Takes all of your pending orders and just goes straight up. And where does it go up?
Sorry, I don't think that you share your screen well, because we don't see nothing.
Oh, really? I'm so sorry. Hold on. Oh, it says my screen is sharing. Do you see it now?
Yes, yes, now.
Do
Yeah,
you see
now
the
it's
screen
correct.
now?
Thank you. The micro E menu
Yeah, the
underneath
micro
it.
e-mini aspect.
Yes.
Yeah.
Yeah. All right. Thank you.
Yeah, no problem. So let's just go over it again. So the definition of an order block is when you have a down close candle, right, that has pierced through, and a down close or up close candle does not matter. And how this is where you would think that, okay, maybe my order block is forming. Now, how will I validate whether this order block is forming? If this down close candle right here is pierced through by an up close candle and it closes above it, the concept of OHLC that I taught earlier. Now, this is my valid order block. More so specifically, this is my valid order block. And what would I expect once my valid order block is formed? For price in the very near future to come and trade onto it where your all the pending orders by the institutions are present, and then take those orders and this rally up, exactly how you're seeing on this example. What happens? Price goes up, comes back down to take all its orders from where? Exactly the order block before it starts going up. Where? Into your fair value gap. Comes back down into your fair value gap, goes back up into your bearish order block, and then pumps down into your order block again, and then starts going down again. This won't go down further because we're on a daily candle, but I will drop down into a lower time frame soon enough. So this was an example of a bullish order block. Now, if we come down, if we go to this, we'll have an example here for a bearish order block. So what is a bearish order block? Go this again. Just not this here, perfect. If you have an up close candle, all right, which has moved up through a down close or up close, doesn't matter. And then you have another candle which goes and pierces through the low of this. So what does this give me? A validated bearish order block. And what is price going to do? And another validation is that it has found support in the form of this fair value gap. All right. So what does price do? Comes back down, trades up. Trades up into what? Your fair value gap. And we can have a look at it this way. So if you look at the open of the candle, that is 15708.50, right? If I bring this here, just turn my magnet on, right? What is this? 15708.50, and look where price trades into. Your first candle over here, trades into it once, goes back down, trades into it again, trades into it again, and then straight up dumps on your Friday. Massive dump on your Friday. See this. And obviously, once you have a order block on a higher time frame, you can refine that on a lower time frame as well. But the idea remains the same, that price trades into it once, goes down, trades into it again, and then look at this. Massive, massive dump. Yeah. If you'd caught this, honestly, it's like unreal money. But regardless. Yeah. So these are your bearish and bullish order blocks. There's always going to be places, they're essentially called order blocks because this is where your institution, they pair your orders up. If you have sellers, this is where they will have all their orders. They will tag this order block and straight dump down. If you have buyers, they will have all their orders up over here. It'll go up once, then it'll come down to take the remainder of its order, and then it will straight pump up. So this is basically what an order block is. You need to know by definition what an order block is. You need to know whether your order block at that given time is validated. Again, in case of a bullish order block, for me, the moment it forms the lowest of the low, finds support on a higher time frame or the same time frame, and then you have the next candle pierces through it. That for me is an order block right there, and I know that price will trace up into it, retrace back into it before it starts going up. Not necessarily all the time. Do remember that. Not necessarily all the time, but majority of the times. I'll give you an example of today, both the trades that I took and posted. So let's have a look. Look at all these fair value gaps. So where did it go? Yeah, so I think if I'm remembering right, I took it somewhere from here. Yeah. Have a look here. I want you to kind of focus on this candle right here. Order block or not order block? Let's see. So I have a down close candle that is forming that has taken the low of this. Doesn't matter whether this candle is a down close or up close candle. As long as it takes the low of it, I expect an order block to be formed, right? How will I validate this order block? I will validate this order block. Now let's go into more detail. When the next candle that is formed, it is pierced through the high of this and closes above this. Does that happen in this? No. Not validated yet. Does it happen again? Next? Yes. Pierces through it, closes up top of it. Now, this is where I want you to know that in case of a bullish order block, if you have a green candle after this black candle and doesn't close above it, but the next candle is also an up close candle and that closes above it, it's still validated. If this candle was a down close candle, that is a black candle, then I would have negated this. If this would have been an invalidated order block, and I would have not preferred to have a trade from it. So as long as you have a green candle or an up close candle or candles that closes above this, I consider this a valid order block. So what happens again? Price pumps up, dumps down. Where does it dump down? Let's have a look. If I mark the high of this, 15337.50. So I've marked my high. This is where I've placed my limit order. Goes up. Where does it come back down exactly? Look at these three candles and look at the respect that the candle gives it. Now, how would I have known whether price after this hitting this order block will go up and not go down? We come back to our previous lecture, OHLC. All these three candles, the candles are closing above this order block. That's more than enough indication for me that yes, but this order block is being respected and the price is going to straight up fly off in the next few minutes. And look at this. Look at this. Sometimes even I fail to realize how much money this shit gives when I trade. You put this and look at this. My target was here, if I'm not wrong. And have a look at this. 4.48 risk to reward ratio. You get a 233 ticks move, right? Now let me just tell you, if you take just 2 micros and you take 233 ticks, that's $233, right? But if you take 20 micros, that equals to 2 minis, as I discussed in the first lecture, that's 2.3K. So 4.4 risk to reward ratio, 2.3K, and I only risk how much? This is where I'd want to tell you about how to manage your trade in terms of your stop loss when you're using an order block. So by rule or by definition, a safe stop loss would be if you're using an actual order block, you know whether this is an order block or not. And in reality, it is the order block where majority of the orders are going to be taken up by the buy programs, institutes. The most sensible thing to do is place your stop loss right at the low of this order block candle right here. How much is that? 14 ticks, right? Now, let's go back to this. Have a look at this. You're risking $140 to make 2,330 if you're a big short. Or what you can do is just simply start off like this, risking $14 to make $233. Still 16.7 risk to reward ratio, which I think is ridiculous. And I've never seen that ever. So this is a perfect example of an order block. Come back to my second trade that I took. Actually, the second trade is something I took off of a fair value gap. So I will discuss that in a while. So the point being made here is that, at least for me personally, I take order blocks as one of the highest confluences in terms of a trade. And how I manage my trade, or how you should be managing your trades in terms of your stop loss, is to have your stop loss set at the low of the candle, the down close candle that makes your order block. But you always have to keep in mind your open, high, low, close, and more so importantly, whether your or mine higher time frame point of interest has been achieved or not. Because personally, the way I trade is I either try to catch the high of the day or low of the day, take my trade, structure starts shifting, stop loss to break even, close my shit, and I just do the rest of my things at home or like outside, and I have my target. And if I'm right, it just goes to that target. If I'm wrong, I come back and it's somewhere halfway between. I close it, or I just close it on break even. It doesn't matter, as long as your idea is correct, right? So these are essentially order blocks. Just to give a small recap, if you have a bullish order block, you're going to have a down close candle that pierces down through the previous candle. How will I know my order block is validated? If the next candle pierces through it and closes on top of it as well. Remember, it doesn't happen in the first candle, but if the next candle is also a green candle, which it is, and closes above it, now I have my validated order block. And what do I expect once I have a validated order block? For price to return or rebalance to that, take the institutional orders for the buy program and rally, straight rally up, which it does to the cent. And this is something it'll always do. You can take more examples if you want to scale up. Take this. Is this an what do you call it? Is this an order block or not an order block? Of course, it's an order block. It's a down close candle that has pierced through the previous candle. Then the next candle pierces straight up through it and closes it. And what happens? Have a look at this. $15345.25. Price wicks down once, comes down again. The second closes below it, but I've taken my fill before that. And the next candle that I see, that is this one, starts rallying up, closes above. Now, if I see this candle, this is my candle where I make my decision of staying in the trade or not based on the order block that I took. Why? Previous lecture, open, high, low, close. Does the green candle not close above this high? It does. For me, that's a market structure shift. And that's it. Price is not going to return back. It keeps on going, keeps on going. Why does it come down? Because at this point, it has met a higher time frame objective. Irrespective of that, if you take your trade from here, go up, that's still a 78 or so. If you start from here, take it up to this structure, that's still 87, more than enough for me personally. But this is why you have a lower tick move, is because you took the order block when you're scaling up. If you've taken the true order block for a true move, that is the lowest of the low, you would have taken all of this up until there. And you would have never had gotten closed and gone up. And it's not necessary that the order block invalidates even in the future. Look at this. The order block is returned back once. Oops, sorry. Price comes back to the order block once, goes back up, trades back down once more to get the orders, and just keeps on going up. Now this dipping back twice, what does this confirm? One thing in mind you have to always keep as in institutions when they're giving their orders up for buy program or sell programs, it never happens in one go. Institutes always pair up their orders in like small batches, or rather lots, because if they didn't, then you would straight up just see this, right? But that doesn't happen. If this is where their order is, it'll go up once, take some of their orders again, go up again, take their orders for the final time, and then rally up, right? And what's happening here? Exactly the same thing. Goes up, takes its order once, goes up, takes the remainders of the orders, starts going up, right? So do keep that in mind in terms of the institutions, that they don't have their orders in just one set go, they have their orders in batches. And you can have a look at it here as well. Keeps on going up. The retrace is where they have the more of their orders, goes up. The retrace is where they have more of their orders, goes up. And that's it. Your sell program begins. And how would I know that the sell program begins? Is because on my 1 minute time frame, candle has closed below this low. So I would expect a sell program. That does not mean I'm going to take a short, because I have confluences and order blocks and fair value gaps. So that is essentially what order blocks are. Bullish order blocks, bearish order blocks. Just to give you another example of a bearish order block, I think I haven't talked about it much. I have a green candle over here. Sorry. I have a green candle over here that pierces through the buy side of this candle. Then I have two candles, consecutive black candles, that pierces through the low of this candle. Validated order block. What does price do? Come down, go up, straight up down. Now my question is, where does it come down to is the main question. If you notice, it comes down to this candle. Now what is this candle? Is this not a bullish order block? And what does price do? Bullish order block, up, down, takes orders, goes back up. Higher time frame point of interest achieved. Now we'll start selling down, right? So these are essentially what order blocks are. And for me, this is how at least I put my orders in, my limit orders in, and where I set my stop loss, always at the low of a bullish order block and the high of the bearish order block. If you get stopped out, or at least for me personally, rather than being disheartened, I realize that, oh, okay, if I've been stopped out, this means this is not a true order block, and price has still a bit of a way to go up or down to achieve the higher time frame point of interest, and I can look for a trade at that point. All right. Personally, would not try more than twice. I'll be done. If I have two losing trades, I'm done for the day, because anything that you do after that is going to be revenge trading, and that's something I have done, but I am trying not to do, and I've been succeeding at that. All right. So these are order blocks. It's fairly simple. You just need to know the definition of an order block. When it's forming, you need to know, okay, now it's forming. And the next thing I need to do is validate whether this is an order block or not. Once it's been validated and you have a candle that forms an order block, that's when you start questioning yourself, are my other confluences aligning or not? OHLC is aligning or not? Have I achieved a higher time frame point of interest or not? Have I? Yes. Price is going up. That means institutions have took their orders, placed their orders, and they're going up, but it has to come down before it takes the rest of it orders, or rather the rest of the bulk of the orders before it starts rallying up. And this is something you can find on any time frame. I'm on a daily time frame. Look at how on the daily time frame the same thing's happening again and again. And you can give so many examples of this where order block has been reclaimed again and again. Have a look at this. This is an order block. Takes the low of the previous candle, triple consecutive up candles, closes above it, gives me a bullish order block. Price goes up, comes down, trades into it again, goes up, trades into it again, rallies up, and then starts consolidating. And why does it do that? Is because of multiple other factors from a higher time frame. So in my opinion, order blocks are very, very powerful things. And that's when I first started learning all of these things. This was something that I told myself, okay, this is what I'll see. This is what I always see at the first instance when I open the chart, and obviously the fair value gaps, because now I have an indicator for it. So these are order blocks, and that's all there is to it. There's only two types of order blocks, and they price consecutively, trades off it on every time frame, even like your 15 second, 30 seconds. So the next thing we have are fair value gaps. So for fair value gaps, you need to know the definition of a fair value gap and whether it's the bullish or a bearish, and what does it indicate? Why is it called a fair value gap, and essentially why is it formed? So if we come here, let's come to this one. So if a fair value gap is formed when you have a candle that pierces through a previous candle, either up or down, and then you have a candle on the other side that closes above or below it, and in the middle, no trading has been done. So if I bring this here, if you look at this candle, forms a high, then a middle candle that rallies up with a majority chunk of the body, and then you have this candle that has its low, and in between the high of this green candle and the low of this downflows candle, you have just a candle with just the body and nothing else. The price has not traded through it, and this just leaves a big, rather you'd say like a gap or a hole. And what does that indicate? It indicates two interchangeable words, that is efficiency or imbalance. And it is this efficiency and imbalance that the institutes are going to look for to come and place their orders into, and then start moving up or moving down, depending on whether it's a fair value gap towards the bullish side or fair value gap towards the bearish side, right? Now, I personally use, when I enter a trade or when I want to enter a trade, these are the two confluences that I need. I need a valid bullish or bearish order block, and right with it, I want a fair value gap. Because when you have an order block and then instantly you have a fair value gap, this tells me that, oh, okay, I have a big chunk of pending orders. Because essentially a fair value gap is just a big void, or would you say a liquidity void, which is like a big inefficiency, and no trading has been done between the up close of the previous candle, the high of the previous candle and the low of the next candle. There's no trading been done. That tells me that in the very near future, there are orders pending here, and the institutes are going to tip their hands, or rather tip their wicks into this, grab their orders, and start running away. And that's exactly what's happening here. If you mark another level, so this is an order block, right? I'll leave that to you to decide whether this is an order block. For me, it is. And then immediately after that, I have a fair value gap. For me, that's instantly, okay, just to know my higher time frame point of interest has been achieved, and this is where I'm looking to take a trade. I have a big fair value gap, and look at what price does, or look at rather where those institutes which are in a buy program does. Look at these. Look at this. What does it do? Fair value gap is formed. Instantly, your buy program institutions, they tip their candles into it, and what does price do? Starts running. Completely starts running up. And that's what your fair value gaps are there for. To form an inefficiency, and those inefficiencies are where no trading has been done. So those buy programs or sell program institutes, they tip their hands into it, they take their orders, they place their orders, they take their orders, and then they start rallying up or they start rallying down, depending on whether you have a buy program or a sell program. And let me just erase this. Right? So the two most important confluences you could use while you want to enter a trade is these two things. That is an order block and a fair value gap. And where you see these two things together, there's a very strong probability that you have a good setup coming up, and this is where you want to take a trade. Now, initially, the fair value gap can get partially filled, completely filled, or left completely unopened. And all these three things indicates three separate things. If you have a fair value gap that has been left completely unopened, as the one that are showing beneath these two purple lines, the three fair value gaps, right here, these three ones, what does this indicate? Or rather, sorry, this one has not been trading into this one. This indicates that there is an inefficiency or an imbalance in the market, and there are pending orders over here, and that in the near future or the future, your institutes are going to tip their hands into it, and they're going to take their orders and start running on a buy program, right? So I don't know if we haven't gone far enough. So at some point, since this is a daily chart, remember, at some point, you are going to see this eventually tip and go up, and then tip down or go up, depending on whatever the situation is in the future in terms of the economics. But that is how it always happens. If we drop back to a lower time frame. Oops. I hate these things, man. Can I not just erase this? So as I said, a fair value gap that is left completely open is a fair value gap that will be traded into, because this is where the inefficiency is. This is where your pending orders are placed, and your institutions are going to tip their hands into it and then come down. If you have a fair value gap that is partially filled into, or more so specifically, a fair value gap where a candle is not closed above the 50%, again, we come back to the same OHLC. If you have a fair value gap that does not have candle or candles that have closed more than over 50% of it, that means that the direction that the fair value gap is in, that's exactly where you're going to be. So if you can see, to make my life easier, and I would advise you to make your life easier, you get this free indicator. It's called fair value gap by Nephew Sam, if I'm not wrong. Yeah. And it just shows you all the fair value gaps based on the settings that you have on. So I personally like to see the fair value gap off the chart, the 15-minute fair value gap, and the 5-minute fair value gap. For me, the 15-minute fair value gap, since I do intraday trades and I scale in intraday, this is something that is respected a lot, and price always retraces to trade into it. As you can see, candles did not close above the 50% of it. So what do I expect? Do I expect this to happen, or do I expect this to happen? Obviously the latter, because that's exactly what's been shown on the chart. But this is something I want you to know, that once again, the concept of OHLC and how powerful it is. That if you look at here, we're in a continuous, this was Friday. See, we started dropping hard. You have fair value gaps that are left completely untouched. Price comes down, tries to go up, comes down, tries to go up, does not reach, because the institutes do not have enough, the buy program institutions do not have enough power in them. There's a lot of selling pressure. So what's going to happen? Price drops again tries to trace up into the fair value gap, leaves it open, comes down, does not even try to go into this fair value gap, forms this one, tries to give the buyers some relief, just enough for the sellers to have their orders filled in into this inefficiency, start dropping down again. And this just keeps on happening, whether you have a buy program or a sell program. So you have essentially these types of fair value gaps, the one that is completely left open to be traded somewhere in the near future. You have those that are partially filled, that is less than 50%, which would mean that my reversal is not coming. And then you have those which are filled by more than 50%, which means that reversal is going to come, and I'm going to use that fair value gap as a support rather than the direction it's telling me to go. So if I had a candle that had closed above here somewhere, this fair value gap that is red, I would have considered as a green one, and rather than inverse fair value gap, and then price to go up like this. So you have to take into consideration these things in conjunction: fair value gaps, order blocks, open high low close. Your open high low close, always remember, whether you find a fair value gap, you find an order block, it is your open high low close that will show you whether that order block is being respected, that fair value gap is being respected. And for me, true resistance and support comes in the form of an order block, fair value gap. I'll give you an example over here. Look at how price is wicking into this. I can for sure say that price is forming, or rather price is finding support. But you have to keep the sentence going. The price is finding support on this fair value gap. And if someone comes and tells me price is finding support, I'll tell them, okay, where? The price is finding support at the fair value gap, because that's what it always does. Institutes, whether buy or sell, you don't know. You'll know on the higher time frame point of interest. They're either the buyers are pulling in their orders, the sellers are getting in their orders, because currently this is a buy fair value gap. And look at how price is perfectly supporting. You would expect this to go up. Why would I not expect this to go up, or when will I not expect this to go up? If I get my fib, get this fair value gap in, if I have any candle whatsoever that closes below the 50%, I would not consider buying at this point. I would consider selling at this point. But for that, I have to draw more into a lower time frame. So that is that. You don't have anything to do regarding in terms of placing. If you want to trade on a fair value gap, as I did today, go back to this. Or rather, this is a good example of how a 15-minute fair value gap is respected a lot. So once I took my trade somewhere from this region over here, even though I TP'd, if I had not TP'd, I would have scaled in. Where would I scale in? If you look at this fair value gap on the 15 minutes, look at how price perfectly respects this. And the other thing is that would scare someone who does not go by these concepts. Actually, why am I on MNQC? Is if you are in a trade and you're going up, and all of a sudden, look at where price. Imagine you are here and price starts tumbling down. Even though you have taken your trade somewhere down here, which I did, and I had TP'd. But if you're someone who does not know of these concepts, you're not confident enough, you have not found the right order block or fair value gap, when this big dump happens, you would expect it to come and take your stop loss, which is somewhere here, which is rather ridiculous. But look at what price does. Over here, on a higher time frame, it comes around perfectly. You have a fair value gap that is forming. The indicator shows it. Perfectly tips its hand into it. Does the candles, either of these two candles, do they close below the fair value gap? No, they don't. What do? The wick comes down, and always remember, the wicks will always do the damage. You might place your order on the low of this fair value gap, and you might have your stop loss somewhere underneath. Even though the candle does not close underneath the fair value gap, the wicks come down underneath it. But it is valid. Always remember, it is valid as long as your open or your close, sorry, your close is above the fair value gap in terms of the bullish fair value gap. And the wicks go down, perfectly tips his hands. The buy program institutes tips its hands twice into this order. And look at what it does here. Goes up straight. So when you come on a lower time frame, the good thing about the indicator is that the fact that I have a 15-minute mark as well on it. Come here. This is what it shows me perfectly over here. If I'm here in the trade, if I'm here and price starts tumbling down, rather than tripping, this is what I see. What is it coming down to? Oh, okay, it's coming down to a 15-minute fair value gap. There are more buy programs that are to be taken by the buy program institutes, and I would expect price to go up. And that's exactly what it does. If on the 1 minute time frame, this is where it's showing the low of the 15-minute fair value gap, have a look at this. Even though on a 15-minute, if you're taking the trade, you have two opportunities. But if you come down onto the 1 minute, which should be your executory time frame for taking the trades, you have four opportunities. Does either of these four candles close below the line that is the low of the fair value gap? No, I've even drawn it wrong. It should be a bit lower since I have the magnet on, but you get the idea. Four opportunities. You miss the first two, price comes up, goes up. But if you know that institutes never have one single lot or single order before they execute that, they put their money into multiple sets of orders. If this goes up, I wouldn't remove my limit order if I'd missed it. I would simply just keep it there. Why? Because I know price is going to come fill my order once more, and then it'll just rally up, and look at this. Look at where it's gone. Look at where it is. Let me erase this. Giving me anxiety. So yeah, you take your trade from here. You missed it 3 times. You have your fourth candle. You're on 378 ticks. That's 3K if you're on two. Minis. For me, that's more than enough. Let's take a live example for a fair value gap. Look at this. What happens? First fair value gap formed, not traded into. What has happened? You would expect it to trade into it. Yeah. You've placed your limit on the fair value gap. Doesn't happen. When is it invalidated? When you have your close below this line. Structure has shifted. I don't expect the fair value gap to come up. The price to trade back into the fair value gap. But I know, one thing that I know is that we're in a sell program now because your market has shifted structure. So what do? I look for my double confluence. Where's my next order block forming? Where's my next fair value gap forming? Look at where it's formed right now. Is this not an order block for you? The up close candle? Before that, it's taken the high of the candle. After that, the down close candle has taken this order block. And look at the next confluence with it. Exactly immediately after that, the same order block candle forms a fair value gap. Does it trade into it? 110% it trades into it. Have a look at this. Trades into it perfectly. Look at what the next candle, look at what the next live candle is doing right now. Look at that. Straight dump. Complete dump. And it started dumping from here, somewhere from here, because your higher time frame point of interest has been achieved for the buyers. They're done, and now your sellers are into play. And look at that. You can sell anywhere from here. You just have to wait. This alone, this candle alone, gives you at least 50 ticks. Pretty crazy. But you can see here a live example is forming in front of you. A double confluence of an order block and a fair value gap. It didn't trade into the order block. That's fine. It traded into the fair value gap. That's more than enough for me. Where will I place my stop loss? Right here if I'm taking the trade from the order block. Right here if I'm taking the trade on the fair value gap. So if I use a fair value gap, I will use the candle that is the median of the fair value gap. I use the high of that candle. If I'm taking the order block, I will just simply put it on the high of the order block. If you get stopped, you learn your lesson for the day. If you don't get stopped, you just keep on shelling. See, we have another order block, and then you can see whether price is going to trade into it or not. But you don't have to see that if you've already been filled out by the actual move. And essentially, this is how you use your order blocks as well as your what do you call it, fair value gaps. At least that's how, these are the only two things that I use when I come down to a 1 minute time frame, because you have to keep in mind that higher time frame order blocks are being respected. Like this, you can only at this time see a 15-minute fair value gap. But if at the same time I come down to the 1 minute, what is happening here? Where'd it come? Yeah. So you have a 5 minute over here, like a big 5 minute, and then you have a 15 minute. Where would you want to scale up into? Obviously, the higher time frame fair value gap, or the higher time frame order block, or the higher time frame high, or the higher time frame lows. What I'm trying to say is that your higher time frame is king. When you're doing intraday trading, 15 minutes is the best to denote the structures. Because otherwise I could have put my long somewhere over here on the 5 minute fair value gap, somewhere in the middle. Both these instances I would have stopped out. If I had put it on the low of the 5 minute fair value gap over here, I would have never got filled in on either of the instances, remember. But if I go to the 15 minute, or rather I don't even need to go to the 15 minute, I have my indicator for that. I see, okay, price is coming down. Where is it reaching for? Where can I scale up for my long? Okay, this order block, sorry, this fair value gap, the 15 minute fair value gap, the higher time frame fair value gap. Why? Because it's going to be respected more. And that's something you can see right now as well, that has been respected more. And if you be very, very, very much particular about it, look at how perfectly your 15 minute fair value gap is filled there, perfectly to the cent. You would have had a zero tick drawdown, zero tick. And if you tell someone I took a trade with a zero tick drawdown, no one in this world is ever going to believe you unless you show them this. You go up, what do you target? This structure. You're done for the day, that's it. This was my second trade for the day. Depending on how many contracts you put in, you'll get your money however much you want to risk, not however much you want to make. Remember that. It's not about how much you want to make, it's about how much you're willing to risk. And this trade, realistically speaking, I would have risked nothing, $0, and I would have gotten as much money as I wanted based on my contracts, and you would have been done for the day. So this is what the point I'm trying to make here is how crucial it is for you to have not sound or extensive, but the right knowledge of order blocks and fair value gaps, and how to use them and how to manage your trades based on that. So I guess that's it for the day. And it's a pretty small topic. I could have honestly stretched this topic to like hours on end, because that's how I used to do it. I used to study these for hours on end, and that's how you should be doing it, not just through this one live example or one teaching session. You should go and dig deeper, find more examples. You will see that if you have a higher time frame, what do you call it? Where'd it go? Higher time frame fair value gap, when you come down to a lower time frame, is going to be broken down into multiple fair value gaps. Which one should I use? How should I use them? I have taught you how to use them, but which one should I use is something I've also taught you based on the structures and open, high, low, close. But this is something that would rather have everyone backtest just how I used to do it. Just sit the whole day, or if you don't have it, give it an hour or hour and a half and just play with it, just go back, play with it, back test, when you're ready, forward test. And see, look at how I was telling you, this is where your support becomes a resistance. Your actual support becomes a resistance. Look how price was respecting the fair value gap on the 15 minutes, wicking down into it. It broke through it. Just so you know, the 15-minute candle hasn't closed yet. Anything can happen. But obviously, by the looks of it, it's going to close below it. So for me now, this is invalidated. I will have to look at a bearish fair value gap if I want to take a look, if I want to take a sell. But if I come down here, see on a 15-minute, you see just one big candle, right? But if you can look here, it shows you 5-minute fair value gap. Look at this. Come further down. I see multiple fair value gaps on the 1 minute. And look how they've all been left just like that. But just this recent one has been tapped into. If you put your order over here, don't get filled, see another one, come back down, put your order over here. Okay, I don't get filled, another one's formed, I put it here. Another one's formed, put it on the low, eventually I get filled, and now price will go down or not, depending on where you are. I personally wouldn't do this, what I just said, because look at how much price is dumped. And look at where it is dumped into. Look at why it is wicking. If I mark this for you, and if I mark this, I've marked 2 fair value gaps, and look at where price perfectly wicked into, and look at where it exactly rejected from, and why the candle is going up. Now it's going up to fill in the fair value gap. If this fair value, if the price or a candle's closes above this fair value gap, I would expect price to go up. And if it closes below, then I would want it to come lower down. But that is not a decision I'm going to be making on this time frame. That is a decision that I would be making at least on this time frame. So yeah, there you have it. And I guess that's more than enough for a day. I would not want to exceed 50 minutes or more than an hour, because then people get bored. So if anyone has any questions, I can see there are people in the public voice chat. More than happy to answer any questions you have, even right now or even after this session or whenever it is. Just remember to tag me. So if anyone has any questions, more than welcome to answer those. You can write them in the chat, as long as I can see the chat. I hope you guys can sort of see my screen and it's not completely blank, honestly. Was everyone able to see the screen, right, this whole time? Okay, yeah, order blocks. Okay, so order blocks will always be at pivot points. Yes, you can consider them to be pivots. Yes, you can, 100%. But you have to know that they will only be your pivot points if your higher time frame point of interest has been achieved. I keep on saying this in a very crude way, but these are for later structures. I will teach when I teach liquidities and higher time frame premiums and discounts in the coming lectures. Then I can more easily be able to make you understand what I mean when I say higher time frame point of interest. Where can you learn more about fair value gaps? Obviously, would advise everyone who's listening to this, and I'll just put it out. I don't want to hide anything. I've learned everything from ICT, the Inner Circle Trader, and his videos are free on YouTube. You just go and type in ICT, and he has months upon months of lectures. His month 4, I think, has the fair value gaps and everything. So yeah, you go to YouTube, ICT is free. That's where I learned everything from. For me, that's my holy grail, and that's what I follow till this date. And that's where you can learn more about fair value gaps. And I would personally always advise to use one source of information, because multiple people say multiple things. But that's the best place to learn the basics from, at least. Then you can build up from there. There are things you will realize yourself, actually, once you start forward testing and then back testing. So yeah. Any other questions? I will stop the screen recording now, because it's almost an hour, but I'm happy to answer any questions.